They produce useful market indicators, and their sector recovery figures for occupier and investor confidence for June show noticeable positive returns for the industrial and retail sectors, but negative numbers for offices. These are macro statistics. What we are seeing on the ground is different and more fractionalized. But COVID-19 is accelerating the trends we have been seeing in recent years. A good example of this is a troubled office sector. Offices in traditional city centres are now less attractive. They are expensive and workers often face long commutes. This has led to suburban offices becoming much more attractive. They are cheaper and staff have shorter commutes. There is a trend away from working 5 a.m. to 9 p.m. to a 9 to 5 day. This could have significant implications for central London, where department stores and central office buildings may now be converted into residential flats, only retaining commercial use to their ground floors. This will require significant government intervention, but having seen the stamp duty, furlough schemes and cheap loans, this may happen, with a trade-off with developers providing apartments for key workers, which will give a silver lining to the dreadful economic events that we have seen recently. Sophia.
Thank you, Richard. So we're going to go into a bit more detail, like I said, about all the sectors, and we're going to start with the office market, which obviously has changed a lot and is still changing with everyone working from home. So Chris, can you start us off, please, by giving us a general picture of the office market?
Yeah, no problem. Hi, everyone. Hope everyone's doing well. Yeah, so as Richard alluded to, prior to lockdown in Q1 of 2020, the office market appeared to be quite strong. One report suggesting the strongest in 5 years. This, although seemingly positive at the time, has inevitably been affected by the lockdown measures imposed. Reports suggested in Q2 that the second lowest levels in the last 5 years due to the inactivity and uncertainties that arose. Early signs of lockdown suggested people would likely move to a temporary working from home basis. However, this can now be seen as becoming more of a permanent way of working in the future. Investor confidence in office market has therefore been hit, and although it is yet to be revealed as to the full picture of the June results, the initial signs are potentially better than people expected. One thing to note is a large amount of people are on the furlough scheme. And it could be argued that some companies may be able to cut certain overheads whilst still being able to adjust and operate with a smaller team on board. However, this experience will differ from company to company. Sophia.
Thank you, Chris. And Richard, do we yet know the true impact COVID-19 has had on the office market?
So at this point, I should say, don't trust the statistics you see in front of you. We're always given lots of information, and you will get, and we get in the marketplace, all sorts of information provided to us about what the market is doing, what the statistics are, but you've got to interpret what you're given. And I'd like to give a good example of this. For South East England offices for Q2, if you look at the market figures, they show that figures fell by 18% as a downturn. But if you take just one big office deal out of those statistics, and this happened just south of London, the actual downturn is 65%. So we might be given statistics showing that things aren't that bad, or even that they're very good, but are they? Behind the statistics we're given, there's always another story, and this is a perfect example of it. If you look at the RICS average monthly rental expectations in both prime and secondary space over the next 12 months, both are negative, reflecting sentiment from agents that they're not happy about the future and what the future is going to give for the office market. So we are concerned. Sophia.
Thank you, Richard. And how will the current picture affect office rents? Surely this is going to have a big impact on rents, Chris.
Yeah, so as Richard just alluded to again, prime and secondary office space over the next 12 months are negative. Central London has seen a slowing of offices which are under offer, down by 20% in the month. And with completions down around 50% in Q2 of 2020 when compared with Q2 of 2019. A large number of deals have fallen through within the lockdown period. And despite this, headline rents have not decreased. However, we expect that future decline as occupiers review their requirements. Along with this, we'll no doubt see an increase in incentives for tenants. And we predict that the market will become tenant-led, whereby landlords will look to keep strong headline rents by offering longer rent-free periods. Alternatively, this may lead to a reduction in rents in certain office locations. Rent-free periods in prime London offices in Q1 were typically between 18 and 24 months based on a 10-year lease. And this may look to increase. Or alternatively, we predict that shorter leases may become the norm to encourage flexibility, which would alleviate the need for longer rent-free periods. Just to touch on investor confidence in the future, the RICS Commercial Agent Survey suggests that investor appetite for London office space remains stable. However, we would apply a large element of caution to this, as the picture may take a turn for the worse as COVID-related guidance changes work patterns. To put a bit more meat on the bone on this, we have the following thoughts, considerations. Will office demand in town centres, particularly central London, now fall away? Will tenants be looking for cheaper or more flexible space? We are actually seeing demand for suburban space with areas such as Watford in demand. As people are looking as people are getting used to shorter days without the need for travel, will the office industry become a 9 to 5 opposed to the historic longer days with travel elongating the day and allowing less personal time? In our opinion, it will be about finding a balance, as I'm sure, although a lot of people have liked the novelty of working from home, people may feel feelings of isolation and disengagement with the team. And I don't know whether you agree, but as good as these Zoom meetings are, although great in the interim period, are no substitute for being face-to-face in an office environment with our working colleagues. Therefore, a compromise may be working flexibly from a local office with the option to work from home. In summary, our view is we are likely to see a reduction in demand for office space, rents and capital values. Although this appears pessimistic, it may lead to further conversions to residential from vacant office space via the permitted development rights, which we've seen recently in the past. Sophia?
Thank you, Chris. Thank you both for that update about office space. We're now going to move over to retail, which is kind of a big topic. There's a lot happening there. A lot has changed over the last few months with everything from panic buying and bulk buying to purchases being much more online driven. So, Chris, what is happening in this sensitive and very vital sector?
Yeah. So like you say, I mean, there are problems in the retail sector. Let's not beat around the bush. There's some disturbing statistics. Retail saw a decline before the lockdown. So in 2019, it had a particularly bad year with a net closure of over 9,000 retail premises, with a vacancy rate of 12.1%, which was the highest since 2013. And the BBC also reported that 2019 was the worst year for retail in 25 years. And that was prior to lockdown. So what about post-lockdown? Retail investment volume sales for June 2020 were 50% lower than June 2019. And retail volume sales 67% lower than the half-yearly, 5-yearly average. When the news of lockdown emerged, there was a lot of panic buying, which helped grocery supermarket sales. In the early stages, the first 2 to 3 week period saw a rise of 30% of sales, and this settled to around 5% increase in May. And while footfall decreased as the restrictions increased, the shops adopted a one-in, one-out policy. What people were buying increased, so the receipts were actually higher per person. Tesco and Sainsbury's, for example, have dealt with lockdown restrictions pretty well. And as travel restrictions were relaxed, stores like Aldi and Lidl, which are a bit more out of town, have also fared quite well. This also kind of runs in line with the consensus that standalone food stores let to major operators are no longer considered as uncertain as other retail operators. However, values are urged to use their discretion on a case-by-case basis when factoring the strength of a tenant in their valuation. With the increase in online retail sales, a new way of shopping may become the norm, especially if social distancing cues remain necessary throughout the winter months, when people will be encouraged to stay at home to avoid poor weather. Amazon have been seen to be the main beneficiary of online sales, amounting to 20% of all online sales. Away from this, generally our view is primary and tertiary retail will suffer, mainly due to the lower levels of footfall and the increase in people turning their shopping habits to online e-commerce. However, secondary retail may fare better, which Richard will discuss shortly. Just moving on to market sentiment. Investors like BlackRock, for example, have been avoiding investing in shopping centres, which looks to have been quite a smart move, as anchor tenants such as John Lewis and Marks and Spencer's have reported they are closing a number of stores, and anchor tenants like this have traditionally held shopping centres together. We've painted quite a dark picture here, but perhaps larger details are being done, such as large retail blocks being purchased by foreign investors. And this may increase as the relaxation of the imposed travel restrictions relax. We don't need to be a genius to realise that retail sales dropped March and April due to the lockdown measures in place. But they have seemingly bounced back a little in May, and we're seeing encouraging signs from agent sentiment that the market has been quite strong, in particular with demand for A5 hot food takeaway restaurants. This has been set against falls of around 12% on secondary retail rents so far this year. Sophia?
Thank you, Chris. So quite a lot of doom and gloom there. Richard, do you have any positives for us in the retail space?
So we just heard that we think that secondary retail rents may be falling, but for London and the areas that we deal with, we're predicting that the secondary retail market will do quite well. We feel this because most of the retail space we see in secondary positions particularly have residential upper parts. And as a property is a long-term asset, what's happening over the next 5 years is more important than what's happening over the next 12 months. With commercial stamp duty rates and buildings that are weighted more to residential use than commercial, these properties are often attractive to owner-occupiers and investors. And I think there's a good market for them now if they're well placed. And a good example of this is Clapham. Some of you may well know the area between the Commons and particularly Abbeville Road. A secondary, tertiary retail location, but the shops are busy. They're located in a prosperous neighbourhood where there's always demand from locals, particularly yummy mummies for their coffees or whatever. But at the same time, the flats above are attractive to occupiers and investors. And as properties go for investment purposes, they've always gone well, and we think they will in the future as well. Sophia.
Thank you, Richard. There's quite a lot going on in the retail space. Chris, can you just give us a brief summary of what we've gone through?
Yeah, sure. It seems like I'm playing bad cop here. Yeah. So yields appear to be weakening as risk and uncertainties increase throughout the sector. Our view is that the retail sector will remain volatile for the foreseeable future as the balance is found between online sales and the high street. And a key point for landlords to consider may be to get the right tenant in, whose businesses may be more pandemic proof, such as what we've seen from standalone food stores with strong covenants. We are a lot likely to see a reduction in lease lengths in order to give tenant flexibility, maybe looking at a move away from 5-year, 10-year, 15-year leases to 3-year leases or even licenses in order to to gain some income. A report by CBRE in June 2020 stated that 65% of occupiers would surrender the 1954 Act for more flexible terms, and 61% of occupiers have agreed rent-free periods with landlords. So we are seeing that trend. Areas with lower retail demand may have to consider reinventing themselves, either by redevelopment as part of a wider scheme, or there is new legislation directing towards permitted development rights from converting the retail to residential, although some professionals have argued this may lead to substandard housing. Sophia.
Thank you, Chris. So we've covered office and retail. The last topic we're going to talk about, and actually finish on quite a positive note, is the industrial sector. Chris, what are the headline projections in the industrial sector for the moment?
The UK industrial output contracted by 20% from April 2019 to 2020. However, there are more encouraging signs for the industrial sector. This is mainly due to the increase in demand for e-commerce and the shift to online sales market, increasing the demand for the need for storage distribution. This market remains positive, however, with a general lack of available stock for logistics space. There have been some key deals recently. They include Segro's purchase of Perivale Park in Greenford. This was 202 million. Aviva have recently purchased 33,000 square foot of warehouse space in Merton, with Ocado signing a 10-year lease deal. And Ocado have remained strong within the COVID pandemic, and they've actually seen their sales increase by 40%. This is obviously due to people shopping for groceries online. And the Amazon takeover continues with the purchase of 2 major sites, the former Pentavia retail park in Mill Hill for £65 million and the Megabox warehouse in Dartford for £200 million. So there are encouraging signs. An agent sentiment is that the market showed limited activity in May, but is now busy, in particular in London and the South East, now performing better. Richard?
So you mentioned towards the end there about agents. Richard, what are the estate agents telling us that you've spoken to recently?
So we don't want to believe everything that agents tell us, because they will paint a picture that they want to paint because they're selling. But at the same time, we know they're very busy. I have a brother-in-law who runs an agency office out of Birmingham and Leamington, and they have got a lot of work on. They're doing a lot of deals right now. Now, we would expect any market recovery to come from London and the South East and roll out. And I think it is. It may be happening quicker than we would normally expect. Hearing what he's had to say about the Midlands and having seen recovery from agents in the South East, I think we're looking at a more positive picture than you might otherwise have thought. But I still say we're in difficult market conditions, and what we're facing now isn't going to go away overnight. But of all the markets, industrial is looking more positive than anywhere else. Sophia.
That's great to hear. Thank you, Richard. And we've touched on rents in both the office and the retail space. Chris, what are the views on rents in the industrial sector?
Headline rents do not actually appear to be falling. Incentives not particularly exciting. Supply for good industrial space remains limited with the lack of land permissions for new development, which we believe is underpinning the market. This applies across the board, but in particular in logistics. Occupier demand in the industrial sector remains resilient and rents are stable and unlikely to weaken this year, which will be set against falls in other sectors. Sophia?
Thank you, Chris. So we're just going to end the industrial sector and actually end the webinar on just giving a summary on the industrial sector. So over to you, Richard, to finish us.
Well, this is the easy one, isn't it? I get the good one to end on, which is that we consider the industrial sector is likely to remain very positive for the next 12 to 18 months, with particular demand in warehousing and logistics. I'd like to put on screen, and I'll give this to Sophia to do, a comment which is made by Simon Rubinson, who is the RICS, Royal Institute of Chartered Surveyors, chief economist. He echoes a lot of what we're seeing, and I think what he's got to say counts. And we're in troubled waters, and this is not going to end overnight, but at the same time, there are some positives, and there is a light at the end of the tunnel in a number of sectors, and those sectors which are facing difficulties do have routes out of them, such as with offices turning into residential. So there are positive aspects of what we see in front of us now. Thank you.
Thank you, Richard, and thank you, Chris. Obviously, there is a lot going on in the commercial space, and what we didn't want to do today was throw too many numbers and statistics at you. The commercial sector is very much changing and evolving, so we're hoping that the update we gave you today has been useful. Things will continue to change, no doubt, over the next few months, and as always, if you need any questions, or if you have any questions, please don't hesitate to contact us, whether it's about commercial or residential, of course, and we will do our best to answer them. But we hope that you have found today's session useful. So thank you very much, everyone, for joining. And thank you, Chris and Richard.
Thank you.
Thank you.